Friends, I request Sri Ved Jain ji, who is past president ICAI and now senior practicing advocate in High Court and Supreme Court, and we can be benefited by his intellects, who will take us through to this all 128 amendments in direct taxes and much more on the budget, which at a micro and micro level both, and interesting value of the budget also. Over to Save Jain ji, please, sir. Platform is yours. And again, Stacey also, whenever he joins, sir, he is up. Also, again, I'll welcome him. And over to you, sir, please.
Thank you, Vinayji. Thank you, Batraji, for giving an introduction to the various amendment on the indirect taxes. All my dear friends, I can see the large number of participants joining in this program, the budget special, which we are doing on behalf of the G19 Bar Room, etc. Friends, the budget was presented almost 50 hours back at 11 o'clock on the 1st of February. And now a lot of discussion has taken place. You would have read the various provisions, etc. Interesting aspect of the budget, as I can just give a few highlights in the first few minutes on the part, is that the geopolitical situation this time was really difficult. The tariff issue was hanging at that point of time. And then the crisis, US, Iran, Russia, Ukraine, all were hanging. And despite that, country has done very well, as the numbers show, that fiscal deficit has been under control in the last year. As against 4.5 projected, it has been 4.4, and the next year fiscal deficit is 4.3. Collection of taxes, both on direct and indirect taxes, has been quite reasonably good that way. And looking to the numbers she has projected, I believe the reactions all along have been positive, except capital market, because of the STT rate. I believe the hike that was that one of the reasons where this issue has happened. Now, one thing interesting in this budget was, I was expecting that the income tax newly enacted just 3-4 months back, what the finance minister will be doing this time, why there should be an amendment to the Income Tax Act of 2025, which is still to be born. It is 2 months away to have its life start beginning, may make a beginning. And what she would like to make an amendment to an Income Tax Old Act of 1961, which is going to die down in the next 60 days. So these were the two challenges. And I always was wondering what will happen in case he says that we have newly enacted the law just 3-4 months back, and this new old act is going to be expiring soon. Where is the need to make any amendment? I'm proposing no amendment to any act. But as I said, this is not possible, and she will never do, the finance minister. She has to give job, keep everybody employed, and including the speakers like us, that we get enough material to speak on amendment to the Income Tax Act. And when I opened up this document of the finance bill and looked into, I was just wondering how many amendments it has made on that issues. Not only the old act, the new act has also been amended. As the Vinayji was saying, there are 129 clauses making amendment on this part, and out of which 29 clauses are at least on the Income Tax Act 1961, which is going to die down on 31st March, and roughly 88 amendment on the new Income Tax Act, which is still to be born. Now, that's a job which he has assigned to it. But I must compliment the Honorable Finance Minister, the way she has carried out the amendment, and she has carried out the various issues. Though there are certain issues which are going to be critical, which are going to be, I think, difficult to implement, and which goes something, so I think the basic tenets of the law. But there are certain provisions where she has given a good relaxation and try to clean up the working on this part, on this issue. Now, friends, I would just like to take you to the various amendments which have been proposed, and not in the serial order of the amendment which have been proposed in the section wise, but looking to the relevance and the importance and the time constraint, because this budget has given so much material, you can speak hours and hours on that issue. But I will try to confine major issues concerning that. As Vinayji said in the beginning while introducing the speakers on the issue, my suggestion will be that since the whole budget direct taxes proposals are to be covered in this lecture, whatever the ideas and thoughts and questions you may have in your mind when I am speaking on that particular section and topic, I will suggest if you can just put in the chat box, and I will try and I will request Vinay in time permitting, we will take each of those questions thereafter on that part. Because this meeting will be a little different of the normal meeting which we normally does every time where we have an interactive meeting. Because this, if we keep it an interactive meeting, probably we will not be able to cover up all those issues on that issue. Now, when the budget is presented, the first thing which was in my mind was, are we really ready to implement the Income Tax Act 2025? Compliment the Honorable Finance Minister. The first sentence he said, now Income Tax Act 2025 is going to be implemented from 1st April 2026. The rules and the forms and the notification, the department is ready and it will be put in the public domain soon. So now we need to be mentally gearing up that Income Tax Act 2025 will get implemented from 1st April 2026, and each of us professional has to get ready and read this Income Tax Act 2025, read this rule, read notification, and make sure that we are able to comply all the provision. My confidence comes up when we in 2017, the GST Act was implemented. I think the whole credit should go to the Chartered Accountant profession that they geared up and they made the law so simpler for the tax compliant, because we are the only chain from the administration to the person who's going to be get affected, that we bring that complexity, try to solve that problem, because the tax laws are complex. It's not easy for a taxpayer to understand it. We as a professional try to make life easier from both sides. Taxpayer making him understand how he can comply with, and in case of any issue arising, going back to the administration or executive, please amend and please clarify on that issue. Now, going by one by one, the amendment made is the first thing which will come in mind the moment that finance bill is presented. Is there any change in the tax rates? The first thing which comes in mind, yes, whether there is any change in the tax rate or not. Fortunately, this time there is no change in tax rate. So for individual, AOP, BOI, partnership firm, LLPs, companies, cooperative society, the income tax rate, the surcharge rate, the education cess continues to be exactly the same which was earlier. So all those ready reckoner which were last year can be used easily in the new this for year, which is the financial year 25-26, assessment year 26-27, and for next year as well, that is the tax year 26-27. Though the new act will be there, but the rate will continue to be the same. But one important change which has been made, I believe you all must be looking to, is that the tax rate of special of 60%, which is applicable in respect of unsecured loan, unexplained credit, unexplained investment, 68, 69, 69A, 69B, C, D, E, which was a draconian 60% rate, is being reduced back to 30% as a normal tax rate. Some of my friends will recall that this provision of 115BBE was introduced during the period of demonetization when the taxation special amendment law was enacted, effective from December 2016, to cover up those cases where people intended to deposit cash, etc., in the bank account and pay tax and advance tax on that so at a normal rate. In order to discourage those people using this avenue by putting the old demonetized notes in the bank account and declaring the income, then this provision was introduced that in case you do so, we will levy tax at 60%, surcharge 25%, and then 4% education, then 78%. And then in add-on, in case you don't declare it, then 10%. Now, the law is being simplified. The tax rate will be continue to be 30%, but the two riders will still continue to be there. I would just like to show you the relevant slide which will help you out on that point. Just look at this. Share kar diya. See, the provision, the rate will be 30%, but this will not be a normal, in case your income is less than 24 lakh or 4 lakh, 8 lakh, still the rate applicable will be 30%. So meaning thereby the rate will not change because your income has gone down. Now you see this, where the total income of an SSC referred to in section 102, 103, 104, 105. This is the new section 68 of 68, 69 under the new act. Determined the income tax shall be calculated at the rate of 60% as 30% as against 60%, and no adjustment in respect of any expenditure or allowance or set off shall be allowed on that part. So now this is the new provision which is there. Existing only rate has been changed, meaning thereby that as and when any addition is made on account of 60% on this issue, then probably this provision will not 60% will not be available, 30% will be applicable. But in case you have a carry forward loss or any loss from any other provision, etc., that adjustment will not be allowed on that part. Now, there is an additional benefit which is coming in. Now, if any person in his own return declare any undisclosed income without telling any source, 68 or 69, or any investment without telling any source, that income will still be taxed at 30%. Since this income is getting disclosed in the return itself, then it will not be liable for penalty otherwise also. So meaning thereby the life has become easier for this. Now it will it will give an option to the people that in case they have any income or etc. which they want to declare from 1st April 26, this will be applicable under the new Income Tax Act only. So this is not for the current financial year, for the year starting from 1st April 2026, which will be known as the tax year. If any person had deposited any money in the bank account or any undisclosed investment in that year, and if he includes that income in his return, pays tax at 30% plus whatever surcharge education says, then there will be no challenge and no issues arising and no penalty on that issues. Now the second change is on the MAT, the tax rate which is there. Now when we see the MAT on the MAT rate, the challenge is now as on date, there are two regimes. One, in case you opt for the new regime, which is called section 115BAA, tax rate is applicable on a company at 22% plus 10% surcharge and plus education cess. But you are not eligible to claim any exemption or deduction in chapter 6, which is ATIA, ATIB, ATIC. You cannot claim additional depreciation. You cannot claim any additional benefit also. Now, but MAT is not applicable. There are companies which continue to enjoy the benefit of the old provision, but they are governed under the old law. The tax rate applicable may be 30%, but they can get an exemption of ATIA, ATIAC, startup, etc. That benefit is available under the old regime. Now, in order to push all these companies to go back and adopt the new regime of 22%, it is proposed that the minimum alternate tax rate is being reduced from 15% to 14%, but with a condition that carry forward of such MAT will not be allowed. First, this is one. I will say the Honorable Finance Minister in the budget speech say in order to encourage company to switch over to the new mode. But in fact, it is pushing to the companies that from 1st April to 2026 onward, in case you are paying 14% MAT, you will not be allowed to take it, carry forward and adjust against the future liability on that part. At the same time, it is being said that whatever MAT credit you are having as on 31st March 26, that will get frozen. No addition will take place thereafter. Meaning that, but in case you adopt the new regime and your liability of regular tax is there, then to the extent of 25%, you can take the benefit of the MAT credit. So meaning thereby full MAT credit will also not be allowed. If you permit me, I can just demonstrate you the implication of this, how it is going to affect the various companies and how the decision is to be taken, because the two issues will arise on an issue. particularly electricity company which are enjoying benefit of ATIAC, ATIA4, and startup which are enjoying benefit of ATIAC, etc. All of these. Now, but GIFT City people are, I will just show you the implication. Now, this, can you go to next slide? Slide below, can Now, this is, I just will show you the slide, this just for the purpose. Share. Now, this is the minimum alternate 15 to 14%. No carry forward from 26, 27 onward. Existing MAT credit allowed only to those companies which switch over to new regime. Intent is to push no impact on units in GIFT City. GIFT City is out of the MAT, which is the most favored. Can you go to the next slide? Now, I just show you the calculations. Now, you can just try to understand how this is going to affect and whether it is really beneficial. Take the year tax year 26-27, a company whose total income is 1,000 crore and it is having an opening balance of a MAT credit of 10,000 crore rupees, because electricity companies are still having a large number of the MAT credit. It is out of 1,000 crore rupees, 900 crore rupees is the income arising from the electricity production, whatever transmission, etc. 100 crore is other income. So it is 100 crore rupees income which is going to be taxed at the rate of 30% plus 12% plus 4% at the existing working. So tax will be 35 crore rupees. And since it is book profit is 1,000 crore, applying the new rate of MAT 14% plus S 16.3, so it will be 163 crore. With the result, this company will be required to pay 163 crore rupees of tax on the basis under the old regime, and nobody working with there. But in case it opts for the new regime as the finance minister is proposing, now 1,000 crore rupees will be the total income. ATI exemption will not be available because it has switched over to 115BAA. The tax liability on this under the new law will be 22% because that is a 115BA, and the total tax payable will be 251 crore. Against this, 25% will be eligible for set off from the out of the 10,000 crore rupees of the MAT credit available. With the result, it will be required to pay 188 crore rupees of tax as against 163 crore which it would have been eligible to, otherwise it will continue to old regime. And that means, and with the result, its MAT credit get reduced from 10,000 crore to 9,937 crore. It loses that credit and additional 25 crore rupees. So switching over to the new company may not be ideal for all. It may still be good for all such company to continue in the old law. And how this is there, I try to work out another example where the income is 600 crore rupees as against 900 crore rupees earlier year. Here also the benefit will still to be under the old law and not the new law. And when it will be beneficial, can we go to the next slide, please? Now, in case this, I try to work it out, that in case income is 462 crore rupees, then only it will be a revenue neutral because the tax will come exactly the same which is there. So meaning thereby, my calculation says, can you go to the percentage which you worked out here, year-wise? Now, can you here this chart indicate that it is only when your income is 46.2%, which is exempt, till such time you are not benefited to switch over to the new regime. So you can still wait for switching over to the new regime because this section, can we go back to the sections? Now, I would just like to take you back to the section. Why I put in the slide? Normally, I don't put the slide. If you see, this is the important. The provision of this subsection shall be applicable only to the NSSC, being a domestic company that has exercised the option under section beginning on or after 1st April 2026. So meaning thereby, it is not necessary for a company to switch over to the new model 115BAA starting from the very first year of 2026. It can continue under the old regime, that is paying MAT of 14% and not to take a credit of the same till such time it is not benefited by the under the new law. And my calculation shows that when your exempt income exceed 46%, then you are not benefited under the new regime. It is only when your total income goes down below 46% of your total income, that's a book profit, then probably you may be having an advantage switching over to the company. So suggestion to the all this electricity company and this startup companies also will be that in case your income exempt is more than 46%, you may continue to be under the old law, and paying 14% MAT will be still be a good proposition as compared to switching over to the new model and taking advantage of 25%. And why this calculation of 25% versus 14% is suitable? A crude way of calculation is against 25%, you are eligible for 25% of that. So when I paid 25.17, and if I can take a credit of 25% of that, that comes out to 7% of that issue. So that will be roughly 18% of that issue coming it out as against 14%. So still you are saving a tax of more than 3% on that part. So this is, I believe, the MAT implication which is there, but there is no implication of MAT on foreign company because the regime will continue to be there, and MAT and this new mechanism of fraud will not be applicable in the case of a foreign company. On top of it, in the case of a foreign company which is governed by presumptive model of taxation, the finance will provide that such company will not be liable for MAT on that purpose. So presumptive model of taxation itself captures that issue, so that there is a now clarity coming it out that it will not be liable to pay MAT on that issues. The third change on tax rate is on STT, which I need not mention. So there is a change because looking to the future and option, the way people have been gambling, this is being considered as a sin tax, not STT really on the increase. The rate almost has been double, more than doubles. And that's a issue which is when the market capital gain, capital market is facing the issues on that part issue. Having explained this all mechanisms of the MAT, now let me switch over to the one important interesting change which was desirable. One was regarding issue of ESI and PF. Way back in 1984, the Income Tax Act has introduced a provision of Section 43B. And the reason at that time of introduction was that many companies used to provide for liability in respect of notices issued on taxation, etc. And where litigation was still on or not making payment. So that's why there was a mechanism provided that tax duty cess deduction will be allowed while computing business income only in the year in which it is actually paid. Going over a period, so Section 43B, number of clauses has been added, which will included bonus to the employees, then it was interest to the bank, then interest to financial institution, and then leave encashment also was added. And then top of it, ESI, PF, etc. was added. So then there was an amendment made in 1987 looking to the employee's interest that even employee's contribution, which is deducted by the employer from the employees, and if it will be deemed to be its income first, 224 section was amended to provide for that whatever employer is deducting from the employee's salary as a trustee, it is income and will be allowed as a deduction under Section 3615A if it is deposited before the due date. And due date was due date of PF and ESI. Now, there was a lot of hue and cry on that issue continued, but time and again provisions were amended and the law was relaxed, saying that in case you make the payment before the due date of filing the ITR, then this deduction will be allowed. But still confusion prevailed because the allegation was that 3615 implies contribution, 43B does not apply because the due date has to be of PF ESI and it has nothing to do with 43B. We had Delhi High Court judgment in the email limited and various High Court in favor, but unfortunately, Supreme Court checkmate judgment came in 2022 saying nothing doing 36(1)(5)(a) stands as it is, and in case employee's contribution has not been paid within the due date, then this deduction will not be allowed. And on top of it, the amendment was made in Income Tax Act in 36(1)(5)(a) also, and saying clarity, providing a clarity that by inserting explanation that in case it is not paid before the due date, it will not be allowed as deduction. This provision I always used to call a draconian provision. How can you say that if ESI PF which got deposited 1 day, 1 hour, 1 month late, that deduction will be not allowed for all times to come? Fortunately, this finance bill has proposed an amendment, though it is effective from next year, that is tax year starting from 1st April 26, by putting a clause in section 29, which is the 36(1)(5)(a) replica in the new Income Tax Act, saying that due date for the purpose of ESI PF of employee's contribution shall be the due date of the ITR. Meaning thereby, in case an employer has deducted ESI and PF from the employee, he can deposit it before filing the due tax return. So tax return 31st July, 31st August, 31st October, 31st November, whichever due date, you can deposit it. You get a period of roughly, in the case of April, roughly 16 months, 17 months, 18, 19 months, and 20 months that way issue. But still one challenge will continue. In case it is not deposited before the due date, it will never be allowed as a deduction. As against employer contribution, which says that in 43B, it will be allowed in the year in which you deposit. Now, in case of employee's contribution, there is a concession now. You can deposit before the due date of ITR, but if it is too late, then deduction will not be allowed. I believe this is a welcome change which has been made, and I'm quite reasonably hopeful that this type of amendment will require. I have all along been saying, if a law is made which is practically impossible, which is arbitrary, that amendment is bound to happen today or tomorrow. This is one of the provisions I have always been saying, that one fine day, this is going to happen, and this has happened. My only wish is that this law is declared clarificatory by the court. That challenge will come up because this amendment is under the new act and not under the old law. And the court will have to analyze this issue, whether an amendment made in the new law can be said to be a clarificatory so as to apply to the old act also. Because the stand of the government is that the new law is a replica of the old law, but it is a simplification exercise. If that be so, what is being intended to be done in the new law should be equally applicable to the old law, and that should be considered to be a clarificatory amendment on that part. When I'm touching upon this issue of deduction from the income, I may incidentally touch upon another issue which has come up and which may affect a lot of issues. Now, as on date, we had a long history of a dividend income. Now, dividend, etc. income which is received was earlier used to be taxable. In 1998, we adopted a new model saying dividend income will be exempt. 1034 we introduced on that part, 1038. Thereafter, we again went back in 2000 saying now dividend income will be taxed. And in between, we had a section 14A saying that expenditure incurred in relation to exempt income will not be allowed. Then we had a lot of controversy on this, how much interest can be imputed on the dividend income, which has been invested by the assessee in the investment on which share. And now we had an amendment in section 57 saying 2 years back that in case of a dividend income, only interest to the extent of 20% will be allowed as a reduction. Now, this finance bill proposes that no deduction of interest will be allowed against dividend income. Now, this is again going to pose a challenge, and my apprehension is the issue which has arisen on section 14A will again crop up now. Now, there is bound to be some dividend income in the hands of a corporate big investment. There is going to be bound to be investment in the share. There is bound to be some dividend coming out of that on issue. And if that be so, and any interest, the assessing officer will dispute it, that a part of the interest paid by you, I will allocate or attribute it to the dividend income, and then hence I will disallow that. He can use two tools, using it 56, 57, or another tool is 3613, where the expenditure incurred wholly for the purpose of business only. And then you say dividend income I will consider the income from other sources. So I will use 3613 to disallow there, or here I will say 57, this provision. Now interest deduction will not be allowed against dividend income. That's another which a change has been made onto it. Now, going by the importance of the topic, looking at time working constraint, I can go to the capital gain. Buyback is one of the issue which has arisen 2 years back. Now, it has flip-flopped. Earlier, this provision was introduced in the Companies Act to facilitate company to restructure its capital, where the promoters believe that the money is not required, there is surplus money, why not to pay back to the shareholders and buy back their share, etc. And many large companies, particularly IT companies, which have got huge cash, like Infosys, TCS, these companies have been buy back the share. We had different model over a period. The last model before the buyback scheme was amended in 2024 was that just 20% tax need to be paid by the company which was buy back the share. This was a very simple model. But revenue thought that there is an arbitrage, that company just pays 20% tax on the dividend as against a person who gets that money of the buyback share. He may be required to pay tax at the rate of 37, 39, or even 37% on that part issue. So that concept was there irritating the revenue, and then they amended the law saying that whatever the money you are receiving on buyback of share, it is a release of accumulated profit by the company to the shareholder, and hence we will tax it as a dividend. Now, this provision was there, and now there was a lot of hue and cry because resident shareholders stand to lose. Individual share particularly stand to lose. When Infosys did it just 6 months back in the month of July, there was a lot of articles written on that issues, that this is creating discrimination, firstly between individual versus corporate assessee. Why? Because corporate assessee, even if you treat it as a dividend, then they get an exemption to the extent of the dividend further distributed under Section 80M. And non-resident versus resident, as dividend income is taxable at a very nominal rate under the treaty. We have a treaty with India, Hong Kong, where 5% rate is applicable. We have a rate treaty with the UAE, where a 10% rate is applicable, where we have a treaty with Singapore, 15% rate is applicable. So they were far more benefited because of capital gain. They say whatever the money we are receiving, we will pay 5% or 10% tax, and on top of it, we will get a complete capital loss of the investment we made. Now that was it. Now it is being brought back. They say no, it will be considered to be only a capital gain depending upon your holding on that issue, buyback, etc. So far you are a non-promoter, no issue. Your tax rate will be whatever capital gain, long-term, short-term, 12.5 or 20% will be applicable. But in case you happens to be a promoter, then you need to pay tax, because then we will consider it to be as good as your dividend, but to the extent of your capital gain. If you have bought it for 10 rupees, you are buying back at 20 rupees, you are getting 10 rupees extra. So you need to pay tax on that part as a normal rate. But in addition, you need to pay tax, which you would have paid tax over and above had it not been a dividend income. Now, in that regard, in case of a company, the rate will have been 22%. So you paid short-term capital gain 2%, long-term you pay 9.5%. And in the case of individual, it has to be 30 minus whatever the rate is applicable on that part. So this is the table which you can see that in the case where the promoter is a domestic company, because 22% is rate, short-term 20% you are otherwise liable to pay, you need to pay additional 2%. And long-term you need to pay 9.5, that is 22 minus 12.5. And in case of an individual, the rate is 30%. So in short-term you have paid 10%, 20%, then you pay 10%. And on long term, you have already paid 12.5, you need to pay 17.5% extra rate on that issue. This is the provision which has been created on the issue. And who is a promoter? Promoter is, in the case of a SEBI listed company, whosoever get classified as a promoter under the SEBI rules. And in case of a not SEBI unlisted company or private company, any person holding 10% or more than equity will be considered to be a promoter on that issue. So that's a definition which has come up, but it again opens up a lot of issues on that part. To whom it get benefit or whom. Now those companies which were earlier benefited because of ATM, they will stand to lose on that part also issue. But now good part is only the difference will be considered, not the entire consideration will be considered. It's a good for individual, particularly small shareholder, non-shareholders. There are challenges, I think, in tax planning which may arise. It may not be appropriate for me to deal with in this lecture on that part, but still I believe in case a promoter just before the buyback sells his share to another promoter, then probably the first sale will be covered under the normal provision because it is not a buyback. And the second promoter, the difference will be too small between the value at which he has purchased the share and the value he will be getting on the buyback of the share. So still, I believe a lot of gap has been left out. Let's see how the things goes on that part on the issue. Another interesting aspect of this budget is some amendment which are retrospective in nature and some amendment which goes back to the what we call a certainty in the law or a law where it brings a little bit contingency. When I am talking of a capital gain, sovereign gold bond is one such issue. In 2015, the government announced a scheme of the sovereign gold bond in order to encourage people that not to buy the gold, physical gold in the market, instead to buy the gold bond. And the scheme says that you give the money, equivalent amount of the value, quantity of gold will be the bond will be issued. These will be redeemable at 5-year or 7-year period, depending upon the scheme. You get a small amount of interest. And at the time of redemption, whatever the capital gain, that will not be taxable. There was no condition that secondary buyer, when he gets a redemption, it will be taxed. All along, this scheme has been going on this part. Now, the challenge has come before the government is that government has issued this sovereign bond in 2015, 16, 17, when the gold rate was hovering 10,000, 15,000 to now it has gone to 1,50,000. When the redemption happens, you have to give equivalent amount of gold, which is substantial. Because if you have given 100 gram of gold at times of bond you are holding, and you have paid 1 lakh rupees at that time for 10,000 rupees per 10 gram, now you will get 100 gram, which will give you roughly 15 lakh rupees. And that to tax free on that part of the issue. Now, government has made an amendment saying that from 1st April 2026, this benefit will not be available to a secondary buyer, meaning thereby exemption will be available only to that bond holder who has originally subscribed to the bond and continues to hold till maturity. This was not part of the original scheme. So my only point is that government may amend the law, but should be done prospectively, not in the manner in which it has been done, because all those people who have bought sovereign gold bond like this, probably they may be in difficulty on this issue. The only saving grace is that this provision is going to come into effect from 1st April 2026. The people who have bought it today and maturity is coming before 31st March, it will be advisable to surrender and more in the maturity, even if they are a secondary buyer, because exemption will be available till 31st March 26, and thereafter this exemption will not be available on that part only. I can skip the small another part. There is a small amendment on the land acquisition, which has also been made of the part of the capital gain. Now I can switch over to the another important aspect of assessment procedures. A lot of changes have been made and life has been made much easier for the taxpayer on that part. The first thing which the government has done is splitting up of the dates of filing ITR. Now we have 3 dates. 31st July for all non-audit cases. We have 31st October for all audit cases other than TP cases, and we have 30th November for all TP cases. There always is a hue and cry on 31st July because the system getting choked, so many taxpayers filing the return. In order to address it and to stagger the return into two parts, all those taxpayers who do not have business income, their due date will be 31st July. All those who have business income but who are not required to get the tax audited, their due date will be 31st August. So this has been split into two parts, 31st July and 31st August on that part. ITR 1 and 2 will be 31st July and other ITR business income will be 31st August. Though in the amendment to section 139(1), which has been made also because this will be applicable from assessment year 627, which is the current financial year, the return will be due there. And also in the subsequent year, it has been made that it is business income versus otherwise, but for trust also it is being said that due date will be 31st August. So let us see how this clarification is carried out. This is a good change which has been made, but this will help in staggering and avoiding IT rush, which used to be there, and the system getting chalked and the portal getting taking time filing the return. Another change in the due date of filing the revised return. Now the revised return earlier used to be a period before the completion of assessment, which used to be 2 years from the end of the assessment year. It was reduced 1 year from the end of the assessment year. Then it was reduced to 9 months from the financial year, assessment year that year. So now, as on date, the due date for last date for revising return is 31st December, which gives a person who is required to file the return in July 5 months, who is required to file the return in October 2 months, and a TP person only 1 month. Now the government says this period can be extended and with a extra fees. So a return can be revised up to 31st December, but you can revise the return in the next 3 months also, that is before the close of the assessment year, but you have to pay an additional fee of rupees 5,000 if your income is more than 5,000 rupees. If your income is less than 5 lakh rupees, if you want to revise it, then the fees, additional fees is 1,000 rupees on that part. So this is the change on the revision of the return, which I believe is a good change, because otherwise after 31st you were required to file an updated return. Now this takes you to the updated return mechanism. Now law provides that a return has to be filed before the due date. What happens if you are not able to file a due date? This has been a continuous push to the government that voluntary compliance is a better compliance as compared to a forced compliance or enforcement mechanism. Frankly speaking, I have been pushing this agenda in all pre-budget memoranda when I was with the Institute of Chartered Accountant of India, as well as with the SOCHM, saying that please allow people to file return at any point of time by charging extra interest and extra tax. Fortunately, this 139(8)(a) provision was introduced 4 years back, allowing filing of updated return even when you have missed out the return or even you have carried out something wrong to update your return and pay extra tax. Earlier there was 2 years, now it is 4 years from the end of the assessment year, which is 5 years from the end of the financial year, which is tax year, which is there. But what we do now, in that, this updated return mechanism is available only when you have, for the benefit of the revenue, meaning thereby there is additional tax payable. So option was available when you have an income and you want to increase the income, or when you have a loss and you want to convert the loss into income. Now, I believe the government has realized the issue that it has to be relaxed further, because there is a possibility you have filed a return of a loss and you still want to reduce the loss. You have claimed extra loss. It is still beneficial to the revenue. So now amendment is being proposed that you can still revise the return where your loss is getting reduced. You can still revise the return on that part, on that part. Another important change, and which I will say is the most important change in this finance bill to 2026. Even after receiving a reassessment notice, where the assessing officer has identified that you have concealed income, your income has escaped, and you don't have an answer to that, even that, you still have an option to file an updated return. That provision has been introduced. Only thing is you need to pay extra 10%, just extra 10%. Updated return. Now visualize how it can work it out. You have particular income which you have not disclosed. You can you could have declared on your own, say your income is 1 crore rupees. And 10 lakh rupees is the income which you have not disclosed by mistake or by intention or by omission, whatever it is. Now, first thing is, in case you are filing a return, you need to be updated that 10 lakhs rupees should have been included, normal tax would have been paid. In case you have realized the mistake after filing the return, but before the due date of revision the return, which now will be 31st March, you can still do it by paying the interest only for that part. If you have missed out that part also, you can update the return within 4 years, depending upon paying extra money. If you do it within 1 year, 25%. If you do it after 2 years, well, then it's 50%, then 60%, 3 years, and then 70%. Still you have not done, and you receive 148 notice. You can still update the returns by paying whatever was required to pay updated return and pay 10% extra. I have done a calculation looking into this, how this is going to work. I would just like to share you for the benefit of you see. I hope you are able to see this slide. I have just worked out an example. This is for assessment year 22-23. 1 crore rupees income escaped is 10 lakh rupees. You say 10 lakh rupees income. You can file updated return up to 31st March 2026 voluntarily. You can file updated return voluntarily. Now, if you file a voluntary return, 3,60,000 will be the tax, 36% on this. You will be required to pay interest 234B on this part, which will be starting from 1st April 22 to 31st March 26. That will be 48 months, and 48% will come to 1,72,000 rupees. This makes tax and interest of 5,32,800. And then you will be required to pay additional tax of 60% because you are revising the return, updating the return within 3 years from the end of the relevant assessment year. This is 3,19,000 rupees. So if you so moto revise, update the return, 8,52,480 rupees you need to pay. But if you are filing this return after you have received the 148 notice, then this 360, 170, 319, 850, you need to pay 10% extra of this tax, meaning thereby 148 notice with just 10% extra, you can get out of this on this. This part I will deal you with later on when I will be dealing with the penalty provision. The second part, this on the table, let me come on that part later on when I talk on immunity on this procedure. So this is the issue which is on the what we call updated return on the issue. Because now 148 also in option to be given. When I am talking of 148, now it takes me back to the issue of Jao versus FAO 151A, which may be, I think, agitating your mind, what is happening and how it is happening. This is a typical case this year in the budget. Some of my friends who have been listening to my lecture, who have been attending my seminar and conferences, probably know one thing which I used to talk about of an example or of analogy which I used to draw with the science in the Greek, where the science has developed. Let me just get back to some Hindi dialogue here. यूनान, जिसे हम ग्रीस कहते हैं इंग्लिश में, साइंस बहुत तरक्की पे थी वहां पर, और साइंस इतनी तरक्की कर गई कि वहां भगवान को लोग भूल गए. जब भगवान को वहां भूल गए तो इंद्र गए भगवान के पास कि साहब आपको कोई याद नहीं करता, और सारे लोग आज साइंटिस्ट की पूजा करते हैं. और उन्हीं के बारे गुण गाते हैं। तो भगवान को बड़ा गुस्सा आया और इंद्र को कहा कि उनको जाकर कह दो कि मैं तुम सबको बर्बाद कर दूंगा और आप भगवान की पूजा करना अगर छोड़ देंगे तो वो इंद्र आए चल के साइंटिस्ट के पास कि भगवान बहुत नाराज हैं और आपको बर्बाद कर वो कह रहे हैं। तो भगवान साइंटिस्ट बोले कोई बात नहीं, हम देख लेंगे। तो भगवान ने कहा कि इंद्र को कि जाकर कह दो कि मैं इतना पानी बरसाऊंगा कि सारा यूनान बह जाएगा। तो बोला कि आप डेट फिक्स कर लेते हैं, आप जिस दिन पानी भराएगा हम भी देख लेते हैं आप में कितनी ताकत है, हम भी देख लेते हैं। डेट फिक्स हो गई 15 अगस्त। 14 अगस्त को साइंटिस्ट लेबोरेटरी में गए और केमिकल से फ्यूम लगाए और इतने फ्यूम उड़ाए लगा दिए कि सारे यूनान को शीशे की छत से ढक दिया। सारे यूनान को शीशे की छत से ढक दिया। 15 अगस्त को बारिश हुई, भगवान ने खूब बारिश होती रही, जितना बारिश का पानी पड़ा वो सारा पानी समुद्र में। इंद्र गए फिर भगवान के पास भागकर कि साहब आप तो फिर हार गए, आप बारिश कर रहे हैं वो सारा पानी समुद्र में जा रहा है बह के, और साइंटिस्ट तो जीत गए। तो बोले अगर ऐसा है तो ओले बरसा दीजिए। सब ओले बरसा दिए गए। उस शीशे की जितनी चादर बनाई थी साइंटिस्ट ने वो टूट गई और पानी समुद्र बह गया। इंद्र फिर आए, बोले भगवान से आपने देखा क्या हुआ आपका, आप हार गए और सी टूट गए। बोले नहीं, आपका खुदा बेईमान। अगर वो उसने कहा था मैं बारिश करूंगा, हमने इसलिए शीशे की चादरें बनाई थी। अगर वो ये कहता कि हमें ओले बरसाने हैं तो हम इसकी स्टील की फौलाद की चादरें बनाते ताकि आपके ऊपर उसको भी नहीं होता। सेम थिंग इज हैपनिंग हियर इन टैक्स। इनकम टैक्स में 2021 में, 2017 वैसे तो 2016 से फेसलेस का फेसलेस, लेस ह्यूमन इंटरफेस, ऑटोमेटेड इश्यू ऑफ नोटिस, ऑटोमेशन एटसेट्रा हैज बीन गोइंग ऑन। 2021 में कानून बनाया गया that income tax notice will be issued only through automated process and there will be no human interface by the faceless assessing officer. And the scheme has to be framed. Scheme was framed is 2022, clearly saying that 148 notice will be issued only by in a faceless manner. Based on that, assessee have been contending that notice issued are not in line with the act and the rules, and hence these are bad in law. If I am correct, at least 7 high courts have delivered judgment where they have said that 151A notice issued by a jurisdictional assessing officer is bad in law because there is a human intervention, because he considers your reply 148AB notice, you submit the reply and he has to take a call. He being a judicial assessing officer, there is a human intervention which is not correct and which is not in accordance with the law of made by the government, hence quashed. Those matters are now pending before the Supreme Court. But now another Supreme Court has come. The government says last and amended 151A, it will not be applicable. A new provision is being introduced, 147A, enabling issue of notice by a judicial assessing officer, and this amendment is being made retrospectively from 1st April 21, with the result all those what has happened, all litigation etc. will come to a knot on these issues. This is one area where the amendment has been made. When I am talking about this issue, let me deal with the 3 other issues where similar amendments have been made. One, this is 151A. Another area was regarding the international taxation, mainly non-residents, where issue of transfer pricing goes to DRP, and there is a procedure prescribed in 144C. Different High Court, particularly Madras High Court and Bombay has taken a view that a notice can be offered. Karnataka and Bombay High Court has taken a view that limitation period will be what is prescribed with 153. 144C does not extend the period. Supreme Court matter traveled. There was a split judgment. One judge says no, it can be done. One said it cannot be done. But now the government has intervened and made a retrospective change, saying no, the period will stand extended, and 153 has to be read along with 144C, and that's why this amendment has been made. Another amendment which has been made retrospectively is regarding the 60 days period which was prescribed that TPU has to issue an order at least 60 days before the date of the completion under 153. For that part also it has been clarified that this period, this is also a retrospective amendment. And the most important retrospective amendment which is going to affect is on DIN, document identification number. This document identification number notification was issued on 1st October 2000, issued by a circular effective from 1st October 2019. I will just like to read out what this circular says. I will just like to show you what is this circular says. This is. No, can you see this? I am reading out the relevant extract. Any communication which is not in conformity with para 2 and above shall be treated as invalid and shall be deemed to have been never issued. ये पार्ट है सर्कुलर का 14 अगस्त 2000 इफेक्टिव का, और उसके बाद जब 1 अक्टूबर को ये इंप्लीमेंट हुआ तो ये स्टेटमेंट है रेवेन्यू सेक्रेटरी का ऑन रिकॉर्ड. Revenue Secretary Dr. Ajay Bhushan Pandey said, from today, any communication from Income Tax Department without a computer-generated DIN, be it a notice, letter, and order, summary or a correspondence, would be treated as invalid and shall be known as in law. This is in pursuance of the direction by the Honorable Prime Minister, in which he has asked the Department of Revenue to come up with a specific measure to the honest taxpayer are not harassed and served better. This is the substance of the circular. Clear. Now what has been done? And based on this, the courts have been taking a view that any such order, etc., issued will be bad in law. Now, to overcome this, a retrospective amendment is being made. This is the amendment which is being made. Stop कर देना चाहिए शेयर को भाई दोबारा. This is the amendment which is being. The Finance Bill 26 is inserting a clause 292BA, notwithstanding anything contained in any judgment, order, or decree. This is the amendment which says notwithstanding anything contained in any. What is the problem? Notwithstanding contained in any judgment, order, decree for the removal of doubt, it is hereby clarified that the purpose of section 292B that no assessment under any of the provisions of the Act shall be invalid or shall be deemed to have been invalid on the ground of any mistake, defect, or omission in respect of quoting of a computer-generated document identification if the assessment order is referenced by such number in any manner. I could not work it out what is the intent. Better would have been to withdraw the circular. But this is what I said, that nobody can win against the what legislature want and what the government want, despite all such litigation going on for the last at least 5 years. Doing in this manner probably is a challenge which I believe is there are certain challenges which are arising on that part. So when we are talking of the assessment procedure, there are two small changes. Let me touch about the such assessment matters. One is the period of completing the assessment is being extended from 12 months to 18 months from the end of the quarter in which the search was initiated. The present law says that it is 12 months from the last date when the search was completed. So the government was, the assessing officer was facing difficulty in a group cases where many of the, in some cases the search get completed local or operated later, in many earlier. So in order to remove that discrepancy, now the period will be not 12 months, 18 months from the end of the quarter in which the search was initiated. So in date of initiation will be relevant. And another change is in respect of the person other than the search person. Now there being a block concept, In case of a search person, 1 year that in which the search is carried out and the 5 year behind, they would all get covered on that part. So this was the challenge which is there. This is no issue. But in case of person other than the search person, the challenge is that even if a small amount of say 1 lakh, 2 lakh rupees entry is found in the books of the search person, the other person gets also covered in get fully covered in 158 BD, and his block is also for this all this period goes on. In order to address this issue, now the law is being amended that in case the material found is of a particular 1 year, only that year will be considered to be the block year. This is a good change, but only the challenge is in the language, which I will just like to you to demonstrate on that part. Now this is the provision which is there. They say where the undisclosed income of the other person pertains to a single tax year out of the 5 tax year preceding the specified year, then irrespective of the provision of the block period in respect of such person shall comprise of only that single year. Now I believe idea should not be single tax year, it should be 1 or more years. So there is a possibility that if you may find out a document at 10 lakh rupees on 31st March of 1 year and 2 lakh rupees thereafter on 2nd April. So there will be 2 years, not 1 year. So it should be confined, not restricted. Idea should be, this is a very good move, but not to single tax year. In case the material is found for more than 1 year or 2 years, then only that 2 year will be covered. In order, then it need not be to cover the larger part of that part. So these are on the issue, the concept of block period on that issue. Now coming back to the issue of penalty. Penalty has been quite a challenge both for the taxpayer and the administration also. So now 2 important changes are proposed on this. One, a challenge which will come to the assessee. A challenge to the assessee will be coming on that part is that now penalty will be part of the assessment order. We all know that as on date, when assessment order is passed, assessing officer issues a notice 271 or etc. Penalty proceedings are being initiated. Those penalty proceedings are kept in abeyance till the decision of the appellate authority comes when an appeal has been filed. So sufficient time is given. Now, in order to remove these 2 proceedings, now what is being proposed is that assessing officer will pass an assessment order and penalty order as one order. So he will issue a show cause notice during the assessment proceeding itself that why not penalty be levied, and he will consider the reply and levy the penalty, and you will receive a notice assessment order along with the penalty order. Meaning thereby, in case an addition has been made, say of 10 lakh rupees, and it pertains to 2 year or 3 years before, and assessee is falling in a bracket of a 30% after including surcharge, education cess, and the amount comes to say on 10 lakh, 3 lakh 60,000 rupees as tax, then interest comes to say 1 or 2 lakh, 5 lakh rupees, and then top of it 200% penalty of tax, which will be 6 lakh rupees. So there is every possibility that now onward, when you receive an assessment order, the amount of income added will be lesser than the amount of the demand that will be created. The only solace which is being given is that on penalty, interest will not be leviable till such time your appeal is decided by the appellate authority to fix it. So that interest, but demand will be there, and that demand can be recovered from you. Only that condition is that in the first appellate state, 10% of that you deposit, then demand will not be recovered further on that part. Now, this is going to be a challenge. One thing, penalty is never considered to be automatic. By this mechanism, virtually this will mean that penalty will be automatic. Assessing officer will make an addition and immediately then he will impose a penalty because he will have no option again. There was no reason why to change this mechanism on that part to levy a penalty, etc. on that part issue. I am just concerned on that part on that issue. But there is another welcome change which has been made on the penal provision. As on date, there is a immunity available when you have the allegation is of underreporting of income. In underreporting, the penalty leviable is 50%. So Section 270 AA says that in case when you receive an assessment order, you pay the tax as per the assessment order, whatever is the demand made therein, and within 1 month you file a application with the assessing officer and don't file an appeal against the addition made by the assessing officer, then you can get an immunity from penalty and prosecution. Then you can get out of this provision on that part of the issue. So that provision there. Now this benefit is being extended in respect of misreporting of income also. So meaning thereby, whatever the mistake you have done, whatever the concealment you have done, in case you agree with that addition, you are ready to pay tax, interest, and then 100% of the tax thereon, then there will be no further proceeding, and you are not filing an appeal against that issue. Now, that gives a good idea for people to get out of this. Now I can go back to that slide again, which I was showing you earlier on one revision on the return, just to show what will happen in this case of even on 148 when you receive. This is not the slide. This is MAT penalty wale slides. पीछे वाली this is ये तो slide थी पीछे वाली. This I was showing you this slide earlier that you file a return, updated yourself, you file a return in response to 148 notice. If you don't do both, and your assessment is made under 148 or later on whatever it is in the realm, the assessing officer will be levying this 7,20,000 rupees as 200% penalty. You will be required to pay 12,96,000 rupees. But now with this proposed amendment where you can get an immunity from penalty and prosecution, instead of 7,20,000 rupees, you will require to pay 3,60,000 rupees. With the result, on an addition of rupees 10 lakh, you will be required to pay 9,36,000 rupees. So now there are 4 options available to you. I will say 5 options. First option is you pay the tax at the due time, including in the return on 10 lakh rupees. Your liability will be just 3,60,000 rupees. Just 3,60,000 because 36% is the rate. But if you don't pay it, but within 3 years, I'm assuming 3 years, but you can do it in 4 years, but 3 years you pay it, you may be required to pay instead of 3,60,000 rupees of 8,52,000 rupees before the proceeding is initiated. Still, you don't want to do it. You have received 148 notice and you want to get out of it. You can do it by paying 9,05,760 after receipt of 148 notice. But still, you don't agree. You want to fight it out and you want to convince the assessing officer. And you are not able to convince the assessing officer and you want to get out of this. Instead of 9,05,000, you will be required to pay 9,36,000. The difference between 148 contesting with the assessing officer and not contesting with the assessing officer is only of 30,000 rupees here in this case. I think that gives a food for thought. What should be done and how it should be done. That's a challenge which will come on that part on the issue. May I just mention when I was talking about this is that in case of an underreporting income pertain to cash credit 68, 69, 69, etc., then you can settle the immunity by not 100%, by 120% of the tax. It will not be 100%, then it will be 120%, but still it will be manageable on that part, on that issue. And when I'm talking of certain penalties, let me just complete. There is a small penalty. In case of delay or non-filing of tax audit report, penalty is leviable at 0.5%, subject to a maximum of 1,50,000 rupees, whichever is lower. This is being now converted into fees with a structured manner that in case it is within 1 month, penalty will be this, and in case the penalty is beyond 1 month, then fees, additional fee pay will be like this only. Similar is going to be for the tax transfer pricing report. So now it will be a fees, not a penalty. With the result, this will be automatic. You will not have a reasonable cause even if you have a reasonable cost still, because fees is automatically payable as is in the case of a 234F, you may be knowing for late filing on issue. When we are talking of this assessment procedure, 148, assessment, reassessment, another issue is coming up is of the black money. That provision has been creating a lot of problem on this issue. So this finance bill has come out with a scheme of what we call an amnesty scheme for a period of 6 months from the day it is launched, and the benefit will be given only to those where this amount of income, foreign income or foreign asset is 1 crore or less. And idea is to give benefit to the students or professional which have been working outside, non-resident, etc., which have come to India, and in case they have not failed to report certain income of dividend, interest, or other investment they have made outside, which have got unreported. So now they can get out of this by availing this black money scheme benefit. The tax with 30% and additional 30% penalty. So you just pay 60%, but this benefit is available only to those persons up to rupees 1 crore only, not beyond. And moreover, where assessment proceedings have not been completed. Where assessment proceedings have been completed, appeal is pending, this will not be available. My suggestion is that by and large people, even if those appeal is pending, they should also be eligible to it. Because the issue is on a bona fide humanitarian ground. Small cases where due to inadvertent error, bona fide student professional income went unreported, or assets remained undisclosed. Idea was not there, ESOP, something like this was there, etc., and amount is 1 crore rupee. So restricting the benefit to those where assessment is pending, then large number of appeals which are still pending, they will still continue to clog the system, and it will be advisable that the scheme should not be restricted to only pending assessment. It should be pending appeals also, to also address the litigation. In addition thereto, you may be knowing a penalty of 10 lakh rupees is applicable in case you have a foreign income or foreign assets which you have acquired from a known sources, but you have not declared in the FA schedule. Because under the income tax ITR, in case you are holding any bank account, you have authority, etc., then you are supposed to disclose in FA what we call foreign asset schedule. Non-disclosure invites penalty of 10 lakh rupees only. In these cases where the asset is from a non-disclosed sources, there is no tax liability, but non-disclosure, that is also part of the amnesty scheme. In that case, penalty of you are just paying 1 lakh rupees and you can get out of this scheme on that part on this issue. We talked about the black money, now we can talk about some of the issues arising in the international taxation. Two issues I have already dealt with. One was 144C limitation, which is 153, which I said there is a retrospective amendment made in 144C, effective from 1st April 2009 as well as 1st April 2009, but making effective from that day itself, meaning thereby now Roka bathroom, shelf drilling, all these cases will get covered in favor of the revenue on because of this amendment in the retrospective amendment on that issue. Similarly, where the transfer pricing officer has passed an order beyond 60 days, then where the period was less than 60 days, all those issues will also be get covered because of the retrospective amendment. Now there are few other amendments in order to encourage investment in India, to increase more manufacturing facility in India. Two major amendments have been made. One, data center. So data center located in India. So income arising which can be imputed to the overseas entity because they are data availing that facility or facility is being availed from that. Now that income will be exempt, and exemption will be till the year 2047 when we are talking of Viksit Bharat. Because data center once a set up is a huge capital expenditure, and if you not given assurance that its income will not be taxed for a longer period, people are not going to put a capital investment in India. I believe that's why the budget clearly says that this exemption will be available till 2047. I only hope later on this interpretation or some interpretation issue do not arise, the way it has arisen in Tiger Global, or the way it has arisen in other cases which I am telling of sovereign gold bond, etc. This promise, what we get promissory estoppel, I believe should continue to be honored till 2047. I believe, hope it will be done on that issue. Another exemption is being given in respect of capital goods, equipments, tools, etc., which are supplied by the outside person in order to facilitate electronic manufacturing in a bonded warehouse in India. Because now many companies has large machineries required, tools, equipment, etc., and they want to increase production in India. Now, if that machinery tools are used in India, income can be imputed to the overseas entity. In order to remove that challenge and ambiguity, it is being provided that in case an overseas company, foreign company, brings here capital goods, equipment, tools, etc., and a manufacturing is carried out here in India in a bonded warehouse, so no income will be imputed. Income arising on account of these use of capital goods, etc., will not be taxable in India on this issue. There are certain benefits which the finance minister has announced, not part of the finance bill, but part of the budget speech, is regarding the safe harbor rule for the IT related industry. She had two things. One, that there were many issues that safe harbor rule applies to whom, because IT services are from related services, back office services, KPs, what we call what value-added service, to what extent, all these will be considered as IT services, and the safe harbor rule will be 15.5%, and the threshold overall, which was the limit was there up to 300 crore rupees turnover, you can take the benefit. That is being increased to 2,000 crore rupees. And as per the statement given later on by the Honorable Finance Minister, she says more than 2,000 companies will get covered, and only I think 30-40 companies will be left out, which will not be covered in this safe harbor rules on that part also. Similarly, there is another safe harbor rule which is being put it out also in respect of the manufacturing also facility. There also they are saying data center services income will be on a safe harbor by 15%. IT is at 15.5, and in the case of a data center, it is a 15% income. Now that I can just convert and go to the now some TDS and TCS provision. You would have heard about the finance minister about TDS. One benefit was motor accident claim. Two things have been made. Interest has been exempted. Interest for delayed payment, etc., which motor accident claim in the case of individual which is received will not be taxable. Secondly, there will be no TDS deduction. Obviously, income is not taxable, then there will be no TDS on that part. Second part is the issue of whether what we call this manpower supply. So there was issue whether manpower supply is liable for TDS. If it is liable, whether it is a technical service liable for 5%. Now it is being clarified. This is not this will be liable for TDS, but it will be at the rate of 1% or 2%, depending upon the entity to whom it is being provided, who is providing. 2% in organized and unorganized 1%. So that's the idea on TDS. There's no other change on the TDS for foreign. TCS, yes, rationalization is being done. Major change is on the what we call on foreign remittances. As on date, on foreign remittances, there are three different categories which is there. If you go to overseas tour, up to 7 lakh, 5% and then 20%. Now across the board, it is 2% which is being worked out on the purpose. Similarly, if it is for a overseas education or medical, then it will be 2%. 0.5% continues in case for education. When you take a loan, it continues to be a 0.5% on that part on this issue. Similarly, now on the issue when we are rationalizing, so there were TCS on scrap, etc., which was 1%, which is being increased to 2%. I believe that's all part of the issue. Now, there are certain other reformatory changes giving relief and concession on that part also. One is to benefit to the individual HF on the part 15G, 15H form is required to be filed in case you do not want to get your tax deducted at source. To the deductor, you have to file. If I am holding share in, say, company TCS or Infosys, I need to file form 15G. If I am holding share in Reliance, I need to file separately. Now, the law says that instead of filing the form 15G and 15H, you can straight away file this Form 15G, 15H with your depository. And single form will do all shareholding in that depository, because depository has a complete list of that period. And that form will help you out. Now that's ease. And depository in turn need to file this form, because who's a deductor is supposed to file with the competent authority. Earlier it was monthly, now it will be a quarterly filing on this issue. Another amendment is certificate of a lower deduction 187, where human interface was involved presently. You have to file an application, go to the TDS officer, convince him that you are eligible for nil or a lower deduction of a certificate 197, which we normally say. Now say in the case of individual HF, it will be only online filing. You just need to put the data there. Based on your statistical data of the earlier year and the current picture which you have projected, certificate will be issued by automated process, 1% or nil per deduction, whatever is there. I believe this is a welcome move which has been done on that part, on the issue, on this part, on this part. When I'm talking of TDS, looking to the time constraint, I will just track to the prosecution also on the issue. TDS prosecution has been a bone of contention and painful process. Now, as on date, prosecution has been divided into four parts, only four parts. One is there, in case the delay is limited only to the due date of filing the quarterly statement, no prosecution. In case delay is of up to 10 lakh rupees, then only fine will be leviable. If the delay is of rupees 10 to 50 lakh rupees, then it can be simple imprisonment up to 6 months. And if it is more than 50 lakh, then it can be a simple imprisonment up to 2 years. So this is the nutshell of the prosecution provision which are there. And these provisions prosecutions are also being amended in respect of the other defaults also. There are other default where you have not cooperated, where you have concealed the income, etc. On all these part is being provided on the same line. 10 lakh, 10 to 50 lakh, and more than 50 lakh. Those are the category which have been made on that part of the prosecution on this part of the issue. These are the major changes which I think it has been made. Now I can switch over to 2-3 smaller provision, because one is smaller provision for which may be relevant for salaried employees. That as on date, there is a provision that whatever the balance you are having in your PF account, at best 12% interest maximum can be given by the employer. Now, for that part, this 12% contribution can be made by the employer, and beyond that, it is taxable. Now, the finance bill says, having set a ceiling of 7,50,000 rupees overall, you may know that it is overall ceiling which employer can contribute 7,50,000 rupees in different fund. There is no need to have this 12% independent ceiling of contribution by the employer. So that 12% ceiling is being removed. As regard income from house property, presently under the new regime, there is a ceiling that you cannot claim a deduction of more than 2 lakh rupees on account of interest in a single year. Issue arose, what happened to the interest incurred in respect of during the construction period, which gets spread over 5 years. So one of the interpretation was 2 lakh plus that interest will be available. Now this finance will settle down that issue. It says 2 lakh rupees include the interest during construction period. So you cannot get that deduction beyond 2 lakh, including the interest during construction period. Of course, you can spread it over a period of 5 years over the period. Now that brings me to the charitable trust and institution. My all along experience has been no finance bill can be complete unless it tinkers with some provision relating to charitable trust or institution, to whom we call NGOs. These are non-government organizations, which is not for profit organization. Fortunately, this time the amendment which are being proposed are to give concession to these NGOs only. One provision which is being amended is, which is I think correction which is being made. Section 139 mandate that a return is to be filed before the due date, and 139(4) gives you an options to file a return, belated return. This provision was missing in the new act in the case of a charitable trust. So now that provision is being amended and that correction is being applied. that charitable trust can also apply, file a return beyond the due date of filing, but before that for the issue on that part of the. Then another provision was, which is specified violation. We all know that in case a charitable trust violates any of the provision, it can lead to a cancellation of a registration. In order to address this issue, that cancellation should not happen in genuine cases or where the issue is of computation only, there are certain exclusions which have been provided where the violation will not be considered to be of a nature that it will lead to a cancellation of registration. And one of the issue was when during the year the receipts from a activity which does not fall within the meaning of the charitable purpose as defined under the old Act of Section 215 exceeds 20%. So on that basis, there was no exclusion. For now, this finance bill has provided that in case there are receipts or income which do not fall within the meaning of charitable purpose, but which are otherwise incidental to the activity being carried on by the charitable trust institution, then the registration will not be cancelled. I believe these are the changes which have been made on that part. There are certain changes regarding the cooperative societies, where the cooperative societies have been given benefit of the same Section 80M. Certain further activity, cattle feed, etc., has also been included as a part of the cooperative societies. And then multi-state level societies also been eligible to claim exemption for 3 years. These are the certain exemptions, may not be relevant for a large number of people who are here. So these are the major changes which have been proposed in the finance bill. I have tried to cover up all, I think, to the extent best possible, the changes which have been proposed in the direct taxes. Vinay, I think we can just open the now discussions for, in case any question we can take up or any issue which are arising on that part. I've tried.
Yeah, definitely, sir. And at the outset, I mean, let me first thank you. I mean, for such a nice deliberation, close by close, and connecting the dots. I mean, this is something is a mesmerizing for all of us, and I mean, nothing has been missed out. However, like I said, just for the information of all the members and for you